Welcome to the Startup Help Desk. We have your source for answers to questions about starting companies, building businesses, and the meaning of life. As always, we have a panel of founders, investors, and entrepreneurs ready to answer all the hard questions from their hard experience so that you don't make those same mistakes that we made along our journeys. All the questions that we answer are submitted by founders just like you because we've been you. We've been those founders on the front lines, struggling with questions, and we're paying it forward. My name is Sean Burns. I was a founder for about 20 years. I am now on the investing side, and I'm joined, as always, by Ash and Nick.
Hi, everyone. My name's Ash Rust, and I'm a startup investor based in San Francisco. I mostly invest in companies based in the US and Europe at the idea stage through my fund, Sterling Road. I've also worked at places like Trinity Ventures and Bullpen Capital as an advisor. Before investing, I was an entrepreneur myself, most notably an early employee at the social media analytics company Clout, as well as the co-founder and CEO of SendUp. These days, I spend most of my time coaching founders, and I've helped more than 1,500 startups over the years.
Hey, what's happening, everybody? This is Nick Melionis. I'm co-founder and CEO of Navi. Our tools and services help people and organizations start and succeed on their innovation quests. I've supported more than 1,000 innovators and hundreds of startups and teams along the way. And I love jamming with Sean and Ash on these questions. I've got my popcorn ready, so let's do this thing.
And you're going to eat popcorn during the episode, Nick. That is going to be fascinating to listen
popcorn, taking notes. That's right. We're ready for everything on this one.
Hopefully you can get some big league chew in there as well. So the full array of the full soundboard.
That's why we can't do video on this thing. You know, there's a lot of consuming going on over here.
Oh, but our real goal today is answer your questions. And all the questions that we'll answer today have to do with how venture capital firms work. A lot of startup companies look forward to or want to or do raise venture capital financing, but we get a lot of questions about how exactly VC teams work if you pull back the curtain. How do they work on the inside? How do they make decisions? So we will do our best to pull back that curtain, answer those questions today. If you have a question you'd like us to answer in a future episode, please head over to thestartuphelpdesk.com. Find us on X/Twitter at TheStartupHD. We would love to answer your question in a future episode. But let's get started talking about how VCs work. We have VCs among us, obviously. We all do investing. So let's do our best to try to shine some light on the subject. First question, what are the steps, internal and external, that VCs follow before making an investment? I cannot think of a more to-the-point question to start this episode. Ash, what do you think, man?
Yeah, so it's a 5-step process, in my opinion. Firstly, there's the email filter. So maybe you've got an email introduction, you've reached out cold, or you've applied online in some form. But that's going to be the first place where most VCs are going to filter the inbound requests out. If they are interested at that point, then there's the first meeting. That tends to be 30 minutes to an hour. You're talking through the team, the product, etc. And if they're really excited, you will certainly know in that meeting because they'll want to schedule another meeting right away, usually adding in their team members. So they wouldn't involve their colleagues and waste their time if they weren't excited. And if they wanted to do that meeting right away after the first meeting, again, that demonstrates excitement. After they've done those team meetings, then you might go to the sort of team decision meeting. That's usually the full partner meeting if you're at a big VC firm where you're going to have the conference room where the walls are made of glass and there's a very long table. There's like 20 people in the room. That's sort of the traditional Sandhill Road, South Park partner meeting. At smaller funds, obviously, it's going to be a lot less people. You may not even be there. Maybe they've already got enough information. But that sort of general group decision is usually the last part of the process in terms of them deciding yes or no. So if you get to that point and they're a yes, then the last step is the diligence. This is more a foregone conclusion if you haven't lied, but they're going to just confirm the claims that you've made over the course of the fundraising process. So your contracts, your revenue, your team, all that kind of stuff has to be confirmed before they wire the money. And that's the last stage.
And I want to be really crystal clear on this because I come across this a lot with founders that have never raised money before. They go into these meetings, the first meeting with the VC, and they think the VC is going to make a decision based on this first meeting. They're like, I'm going in, I'm meeting with venture capitalists, I'll pitch them, and then they'll invest. And I want to be crystal clear, Ash, that never happens, right?
Correct. If someone is writing a 7-figure check plus, you are going to be doing multiple meetings. And a lot of VCs kind of lull founders into that feeling that they are one meeting and then, making a decision by saying things like, oh, well, let me do some diligence on this. So using that word makes people think that we've skipped to the end of the process and it's just a matter of doing that. And then they're going to come back with a big yes and a massive check. But no, that does not happen in almost all cases.
Ash, do you have a rule of thumb as you think about top of the funnel? What percentage of leads go from email filter into first meeting and then into a meeting with the team? Just looking at those stages there.
Yeah, the first few stages are very, very narrow. So you're going to see that like 99% of the requests via email are going to be a no for most people. I mean, we get thousands and thousands of requests via email and then, thousands of requests on our applications as well. So that's an awful lot.
And only half of those are me spamming his website.
Right, exactly. Only 10% of them are Sean sending in pictures. So, so there's a lot of volume there. And then in terms of like first meeting to second meeting for us or first meeting to excitement for us, that is another like 95 to 99% no. Right. So we meet with 1,500 companies a year or so, or review 1,500 companies a year, and only invest in about 15.
So you're saying there's a chance.
That's the optimism you need to be a founder right there.
Yeah.
Right there. I love it. Okay, quickly on to the next. We have a lot of questions. We're trying to stuff more questions than normal into this episode since we do get so many of these. Next one, Nick, I'm going to throw this one over to you. What happens when VC partners disagree about an investment? So a firm that has more than one partner, I guess they're not agreeing if they should invest. What happens? This is a good question. Nick, what do you say?
Yeah, there's a couple layers to this. One is the fact that this is something that a firm will define a process around. And the second piece is how you as a founder can be able to navigate it. So first, in some cases, VC partners will often decide between two different types of decision-making processes. They'll either decide that they need to achieve consensus. And so that means that every partner needs to agree in order for them to allocate capital into this investment. Or they can decide that if a single partner has conviction, then they can be able to decide to invest without achieving consensus. So that's something that firms can be able to decide upon as part of their process. As a founder, it's critical to understand how to navigate through this. You can do this through that first meeting, but ideally you can do this beforehand as well online. You want to make sure that you understand what is the process and overall decision-making sequence that a firm follows. And so you want to know typically how many investments does a firm make over the course of the year? What are the steps they go through in terms of their diligence process? How many people need to agree to invest, i.e., is it unanimous or do you need one partner? And then critically at the end of the day, with that information, the way that you can be able to achieve this quite challenging outcome to achieve an investment is you got to get at least one partner who is truly obsessed with what you're doing. That gives you a chance to be able to break through and secure this investment.
I don't know about you guys. I think that surprised me most as I learned more about how this works was how rare it is that all the partners do agree, at least initially. Like it isn't the case that you pitch the partnership, you walk out, they're all like, yes, we have to do this. It's there's always, a lot of behind the scenes work that goes into getting somebody over the line so that they do get to agreement. But it's I don't know if I haven't been involved in that many of these processes, but it always amazes me that like how rare it is. I can't think of actually any cases that I've ever been involved with where it was unanimous out of the gate. Have you guys ever seen that?
Same for me, Sean. Yeah, I think that there's always someone who wants to be the contrarian in the room, especially when there's a bunch of people and the doors close. The key thing that Nick highlighted there is you need someone who is so obsessed, they're willing to push through all these other objections and perhaps stake their career at the firm on this investment. And I've seen that over and over again where someone pushed super hard for something to be a yes. And they were either right or wrong. And if they were right, now they're a general partner or, they have their own fund, managing partner, something like that. Or if they were wrong, now they're back being an operator.
And by the way, that was Ash's. Since Ash has his own fund, that was his way of saying he was right.
Yeah.
The people who need to know that, they know. If you know, then
I
you
wish
know.
that was the case. I'm just so humble that I wouldn't have even realized.
That's too
Ash,
good.
you're
Yeah.
easily the most humble person we know by far.
Thanks, guys.
I think that is such a key call out though, going back to the obsessed piece. At the end of the day, your job is to equip one partner or more with the arsenal that they need in order to get this thing to the finish line. And so to get there, you really do need to captivate them in an incredible way and make sure that they are obsessed. If they are moderately interested, then there's just so many roadblocks that will stop this from getting to the finish line.
So true. So true. Okay, we got a lot of VC questions. Nick, what else is on the question queue for today?
All right. So this founder asked us, what are VCs looking for? This is a fantastic one to keep our momentum flowing here. Sean, do you want to take this start?
Well, the good news is we have 3.5 hours to cover the answer to this. So let's really settle in.
Yeah, I think we should talk about lake houses to begin with, because that's obviously the first priority.
There's no simple answer. I will do my best to answer this simply. So the first is to keep in mind VCs are in the money management business. They take investors' money, they limited partners' money, and their goal is to produce a return on that money. And the return has to be significantly better than other options because VC has a lot of risk. Most of the investments you make in VC, the companies fail. And so there's a lot of risk involved. And so the outcome of VC fund has to outperform, for example, the S&P 500 index. Because if it doesn't, it's easier for me to just invest in the index and get my return and have lots of liquidity with very little, well, there's risk, but less risk than in the VC fund. So their goal is to produce return on investment. That's their goal, 1,000%. It's not, their goal is not to make your company successful or support you as an individual. That's their goal. There are other things that help them achieve that goal, like supporting their companies, but that is their goal. Now, what does that mean they have to look for? Well, they're looking for companies. If you think about it, if most of their companies are going to fail, that means a few of them have to be such egregiously extraordinary outcomes to both pay for the ones that failed, but also produce a return on this investment. That means you have to have a huge market so you can get to huge money. You have to have some sort of competitive advantage so you don't stall out or competitors don't come and steal your business. And you have to move fast because a VC fund typically has like a 10-year life cycle, which sounds like a long time. But if you're trying to get to $1 billion outcomes, 10 years is not a super long time. And so if you don't have those three things, or if a VC does not think that your company can be one of these companies with those three things and be one of these companies that will return my fund multiple times over, you are not what they were looking for, which is, by the way, fine. There's a lot of businesses that are not venture backable, that venture capitalists won't invest in, that are perfectly fine businesses. But that is specifically what, in my opinion, VCs are looking for. Now, Ash, here's your chance to disagree with me. Let's go.
No, I think it's pretty much exactly what you're saying. I work so much at the
the episode is over. We are now canceling the podcast. We have achieved perfection.
No, I got too much popcorn still here.
Right. Nick has not got done chewing yet.
Yeah, this is why I brought this.
Still got to keep going. Yeah, I mean, I think that the main things that I want to differentiate is that it is slightly different at the very, very earliest stage. And then just what the expectations are for VCs, those sort of slightly later stage investors. So if you're thinking about an accelerator program, like someone like Y Combinator, Pair, Andreessen Horowitz's speedrun program, this is my personal opinion, so it's not an official opinion, but I would say they're looking for three characteristics. And the first one is always going to be team. What are the outlier abilities on this team? Secondly, they're going to be looking at engagement. Like, what have you built so far that is getting people to, be really engaged, to be reliant on your service, to really express their desire? And then acceleration. What do you have coming up? What is your plan? What are the expectations over the next few months where you're going to suddenly pop on growth such that at demo day you can have a great fundraise? So that's what I would say accelerators are looking for. I think for VCs, a lot of what Sean said around it being a massive market, very, very important, or in a market that moves fast, so like not ed tech in most cases, for example.
No shade thrown.
No shade thrown. And I just did an ed tech investment as well, but honestly, the founder was just so sensational. I was like, just take my money. I don't care if you're growing rhubarb in the field. Competitive advantage, absolutely crucial as well. I like to think about that as like a technology advantage or the defensibility, but of course it could be network effects, it could be a user experience advantage. But over and over again, it's going to be coming back to this sort of like overwhelming team advantage. Like, what do these investors see in your founders and executive team that makes them believe you can take this another 10x? And I think we see that even in the public markets with these latest, trillion-dollar pay packages for CEOs. The team is far and away what people want to see, and that, the team's ability should be reflected in growth.
And to be clear, we do not get paid $1 trillion to do this podcast. We actually capped our salaries at $1 billion because we wanted to be more reasonable stewards of the business. So just in case anybody out there was wondering,
with the common person.
But saying that, if there's any podcast that want to pay me $1 trillion to come on as a host, I will ditch these guys and jump in a second. You just give me a call.
Are you not interviewing to be a researcher at OpenAI?
I'm going to be a podcaster till I die, man.
It's the only way to make the real money.
Okay. Let's keep going through questions about how VCs work. Okay, here you go, guys. What are VCs measured by? What is success for them? That's a very good question. I think it gets to the heart of the matter. Ash, what do you think, man?
Yeah, so ultimately, it's a number called DPI, or distributed to paid in returns. So how much money have you sent back to investors versus how much money they gave you at the very beginning? Now, when you have good numbers on this, i.e., you've returned 2, 3, 4x, whatever investors gave you, it is all you talk about, because it's very rare that VCs have this. And when it's going well, you'll tell everyone. So we had a company go public in 2024, and any poor soul that met me over the last 12 months has heard about it. Before you get to DPI, most people who are limited partners are going to accept 2 other metrics. One is multiple on invested capital. So that's MOIC. That's kind of the paper gains on the money you've invested. So if companies have been invested in by later stage investors and their priced valuation has gone up, although it's not liquid, you can measure on that. And then within that, there's also IRR, or internal rate of return. Now, this is a little bit more complicated. Feel free to Google it. I won't go into the full details of it. But basically, it's the measure of the rate of growth of your investment. So how much are your investments growing? And so that sort of is the reflection of whether or not they're beating the S&P 500, as Sean mentioned earlier. But if you want to actually get paid as a VC and get that lake house, then you need DPI, those distributed to paid in returns.
And it amazes me, if you look at the distribution of data, that only the top quartile of venture funds actually match the S&P 500 on a DPI basis, if you look at it, which is mind-blowing if you think about it, that so few venture funds would even match the S&P. And by the way, if you want to beat the S&P 500 by a lot, you go even higher, top decile, for example. It's just shocking to me that you have to be that good as a VC just to compete with the index funds in the stock market. But it goes to how hard investing is, honestly. It's very hard.
Yeah, that is definitely a lot of people that we've lost. I've been doing this since 2017, and obviously the vast majority of people have not been able to raise their third and fourth funds who began with their first fund at the same time as I did. So very, very fortunate to be in those groups where it can happen, and that's as a result of those DPI.
And how is the lake house, Ash? Is it nice this time of year?
You have to wear the vest, but in the closet.
One question when it comes to those who are managing funds, let's say that you're not in that top 25% or that top 10%. How long can you continue to bring on new capital in order to raise new funds, so to speak, before the market ultimately just says, no, you got to go elsewhere? How long can one persist?
Sure. So the standard thought process on that is that you won't raise your third fund if you haven't done well. But of course, that's completely situational, right? There's plenty of people who have patrons that believe in them, or maybe they're working on longer timelines because they're deep tech only. And so maybe they were able to get a little bit further. I would honestly say that with Sterling Road, we kind of got through raising 3 funds before we saw the DPI. And so, we were very fortunate. That might be because of all the great advice I've had from you two about fundraising. And
nice.
So that extra, boost of knowledge really took me over the hill. And, I'm willing to do a lot of meetings. So that probably is the reason why Sterling Road survived into Fund 3 versus necessarily being successful on those returns side. But as you get more and more of those returns, it gets a lot easier to raise the funds for sure.
Oh yeah. You make people money, they're happy to give you more money to make them more money. That is how it works. I'm curious, you guys. This wasn't a question that was asked, but I find a lot of founders don't understand this. We've talked a lot about how VCs work, but there's one thing that constantly comes up, which is you raise money from venture capitalists and you have the chance to, for example, sell the company for an okay outcome, but not a great outcome. And the VCs want to push you to not take the money, but to go for the risky go it alone strategy. You're like, hey, I could buy a lake house with this. And they're like, no, we got to keep going. We got to aim higher. Can you walk everybody out there through why that is? Because it doesn't seem super intuitive. You're like, we're getting this money. But from a VC perspective, if you understand how VCs work, it actually can make a lot of sense.
Yeah, exactly. It's going back to your point earlier, Sean, that they only care about massive outcomes. And so if you have a chance of being that one massive outcome, they don't care if you're risking complete failure. Because if you sell for a good outcome, you're guaranteeing you're not that massive outcome and thus irrelevant.
I think that this speaks directly to this question about what are VCs measured by as well. Ultimately, translating this for a founder, what that means is that exits matter. And so then VCs want to invest in companies that can grow to incredible heights and that you can sell, so you can get acquired, or you could IPO, or another form of an exit. And so the economics of that are something that often founders don't know on day one. And so what you'll see is a founder will perhaps persevere with a company that's not growing so quickly, but they'll just say, I don't want to lose this investor's money. And so they might continue for a really long time moving forward, when in reality, a small exit is not the metric through which a VC is measured by. They are measured by exceptionally large exits.
Absolutely. That's such a good point, Nick. There are a number of times I have to warn founders that they're putting their bodies on the line to try and get an acquisition through that is not going to influence my bottom line. And they think they're doing it for me. And that is a big misconception.
And basically what that means is when you're building a venture-backed startup, you should, of course, pursue incredible heights and know that you and your investors are aligned towards those incredible heights. But the lukewarm heights are not things that you should pursue endlessly, because that's not what a VC is measured by.
That's a good point. Maybe the overall lesson to take away from all of this is that if a VC invests in you, you are not on the same team. You're kind of almost on the same team. You have
unless
shared interests,
it's me, and then it's different because
that's right. Unless it's
we
Ash.
really focus on founders first.
Yes, true.
So there you go. Well, hopefully we've pulled back the curtain. You understand a little bit more about how VCs work, how they think, what their incentives look like. It's very different than if you're a founder of a company. And while they do probably on a personal level want you to succeed, on a business level, they have a very different algebra they have to go through. So hopefully this has been helpful. It's not super common that people pull back this curtain. So Nick and Ash, thanks for pulling back the curtain, exposing the inner workings of how this stuff goes.
Yeah, thank you both. Absolute blast.
Thanks, Sean. Thanks, Nick.
I appreciate it.
We will return. And if you have a question you'd like us to answer when we do return, head over to thestartuphelpdesk.com or thestartuphd on X/Twitter. We would love to answer your question in a future episode, whether or not it's about VCs or anything else. We have lots of episodes. We love to answer questions, so ask more of them so we can do it. The Startup Help Desk is now closed. We will return. In the meantime, good luck in building your business.